Welcome to wherever you're joining us from today for our latest webinar on how to account for climate in financial reporting. My name is Sundip Jadeja. I am a technical manager at the Climate Disclosure Standards Board, CDSB. Joining me today, really pleased that both here today, two very experts in this space. Helena Watson, Director at within the Accounting Advisory Services team at KPMG UK, and Charlotte Lowe, also Director, but within the Banking Advisory Services at KPMG. Welcome to you both. Thank you so much for being with us today. To quickly introduce the CDSB, for those of you who don't know who we are, we're set up in 2007 at the World Economic Forum to advance the integration of climate and environmental information into annual reporting, the mainstream report, by companies, for the benefit of investors to aid in their capital allocation decisions. Ultimately, one of the pieces in the puzzle to transition to a low carbon future. If we bring the slides back on, just want to say that today we've launched a supplementary paper to the guidance that we first published last December, which in supporting preparers in integrating climate into their financial reporting. So the December 2020 paper covered three broad questions. Are climate-related matters relevant to financial reporting? How should climate-related matters be factored into a company's financial reporting? And what might this look like? And finally, also covered what steps can companies take to integrate material climate-related matters into their financial reporting. So just to confirm again that we launched a supplementary paper today. But before we actually get into that, just to step back, why are we even talking about this? So in recent years, the recommendations of the Task Force on Climate-Related Financial Disclosures, TCFD, have been a significant driver in the improvement of narrative reporting of climate-related information by companies. That being said, there's still a long way to go on TCFD reporting. So one concern that continues to be raised is whether climate-related matters that are reported in the front half of annual reports, in other words, management reporting, narrative reporting in the UK, strategic reporting, is in line and consistent with numbers and accompanying notes in the back half. And by back half, I mean financial reporting, financial statements. And so therefore, there's a concern as to whether investors are being provided with a complete, coherent and consistent story with regards to climate in companies' annual reporting. Now, there have been a number of significant developments when it comes to financial reporting and climate in recent years. Significantly, both the IFRS Foundation and the International Accounting Standards Board, IASB, have published papers in the past 2 years clarifying that, one, although climate is not referred to explicitly in the accounting standards, where climate-related matters are material, they need to be reflected in the financials. And building on the second point, and quite a key point, is that when determining whether climate-related matters may be material, judgment is required by companies, by preparers, on both magnitude and the nature of the matter at hand, or a combination of both. So in other words, even if climate-related matters may not have a material impact on a company's financial numbers, based on its size, disclosure may be required due to its very nature. The IASB paper, the IFRS financial papers, go on to explain that in the context of climate-related matters, investors may expect disclosures in the financial statements regardless of numerical impact, in which case such matters should be considered material. And significantly, investors have come out supporting this position publicly. So in September last year, some of the largest investor groups in the world, representing over 103 trillion in assets under management, published letters confirming that they do consider climate-related risks to be material factors. And so companies should be reflecting this appropriately in their financial reporting. And since then, there have been other calls, public calls by investors kind of confirming this position. So a quick example of what this means, what this might look like in practice. So for example, you may have a bank which holds debt in a region facing severe forest fires. Now, it may need to consider whether a write-down is needed on this debt, or whether disclosure as to exposure is warranted. Ultimately, the bank may determine that it's a material, that the risk is immaterial from a size perspective. Specific debt is not exposed, or the size of debt originating from that region is very small. However, if peer banks have provided disclosures on their exposure to this debt, a typical investor may expect disclosure as well from the initial bank. So the disclosure of the facts that the first bank is holding a very small amount of debt originating from this region, while other banks operating in the same region have larger holdings, ultimately will provide the entity's primary users with useful information about how effective management has been at protecting the bank's resources from unfavorable effects of climate change in that region, or simply just confirming the fact that the bank's exposure in that region is small compared to its peers, and thus from a size perspective isn't material. In the first paper, we go into a lot more detail covering kind of four standards: IS1, IS 37, IS 36, and IS 16. But since we published that paper, climate and financial reporting is in more focus than ever, and so that was the reason why we've continued focusing on this and why we've produced the supplementary paper today, and why we're continuing to do work around this. So just a couple of kind of highlights of what's been going on in the past year or so. The big six accountancy firms at the very end of last year published a letter committing to engage with companies to encourage greater transparency on the impact of climate-related matters in companies' financial statements. So this remains and is very much on the radar of auditors. Another important aspect is that this is not just simply something that the IFRS Foundation is looking at. And as we know, the IFRS standards apply to over 140 plus jurisdictions. The big gap is the US. But actually, the US Accounting Standards Board, FASB, produced an education paper earlier this year, illustrating how entities may consider the effects of certain environmental, social, and governance matters, including climate, that have a material direct or indirect impact on the financial statements. And so, you can see that FASB is not just looking at climate, but actually is expanding consideration to broader ESG matters as well. And then finally, a recent review from the Carbon Tracker Initiative highlighted that despite all this recent pressure and focus on this area, 70% of listed companies reviewed in their research, including some of the world's biggest emitters, did not fully account for climate-related risks in their 2020 financial statements. But clearly, a lot of work still needs to be done on this, and reiterate the point that why we're producing this guidance and why focus needs to be provided by preparers on this matter. So as I mentioned, the supplementary paper looks at additional standards, those standards that were identified by the IFRS Foundation in their initial papers. It doesn't cover every single kind of consideration, but it provides kind of highlights of the type of things that preparers might need to consider when considering climate and financial reporting. So I've said plenty on that. What you're really here for today is to hear a bit more from our experts in terms of the type of things that you should be thinking about. And so I'm going to pass over now to Helena and Charlotte to give you a flavour of what's considered in the supplementary paper that has been published today. So over to you both.
Thanks. Thank you, Sundip. Hello, everyone. I think it's such a great privilege to be here today, talking about what is such an important and as Sundip's explained, evolving topic. Just before I sort of launch into the technical content for today, I just wanted to introduce myself briefly. So I'm a director within KPMG's accounting advisory practice here in the UK. And personally, I specialise in corporate reporting. So that could be disclosures in the financial statements, such as the climate-related impacts that we're talking about today. Or it also covers the more narrative parts of the annual report, supporting clients on topics like TCFD, or the really exciting developments going on in the field of sustainability-related financial reporting. So what we wanted to do for today was to just introduce you to some of the key ideas that we've included in the paper that was released earlier today. So yeah, as Sundip said, the paper wasn't intended to be a complete list of all implications from climate on financial statements, and it's not intended to cover all industries. The aim of the paper is really just to provide some illustrative examples and ideas about how climate might impact your recognition, measurement, and also really importantly your disclosure. In case anyone's concerned, there's no test, and we certainly don't expect you to have read the paper yet. It was released this morning. the idea of this session is just to introduce you to some of what we think are the more interesting points from the paper, and think about how those might relate to your reporting. So I'm going to start off by talking a little bit about how climate can impact accounting under each standard, and then we'll try and bring it to life by discussing one of the illustrative examples in the paper. We've got up on the slide the first standard that I'm going to cover, which is IFRS 13, fair value measurement. And then later I'm going to pass over to Charlotte, who's going to cover the financial instruments standards. So that's IFRS 9 and IFRS 7. And then I'll pick up again at the end to talk a little bit about IAS 12, so for income tax, and also IAS 2 for inventories. In case we've got any insurers or preparers who do have insurance contracts, if you're listening in the paper, we do actually also cover IFRS 17, so that's the new insurance contract standard. But as that standard is not yet effective and a little more specialised, we decided not to cover it on the webinar today. However, if it is something you're interested in, please do have a look at the paper and get in touch if you've got any questions on it. So, first standard is to talk about IFRS 13. Now, clearly, IFRS 13 is a hugely important standard in IFRS because its principles are used across so many other different standards. Fair value is a concept that is now used in a lot of places in IFRS. Thinking about what types of examples, so it could be in the context of a one-off transaction, like an acquisition, where you might be fair valuing the acquired assets and liabilities. That could be a one-off transaction, or it could be part of an ongoing requirement to measure perhaps certain financial instruments or something like investment properties or biological assets. In some cases as well, we know that fair values is a choice to use that, with perhaps you might have a policy to choose to hold PPE at fair value. And it's also something we will mention today, is that fair value is also a key part of impairment testing, where it might be necessary to calculate a fair value less cost to sell so that we can then compare that with value in use. So it's used in so many different places. So if I reflect on some of the key principles of IFRS 13, I'm thinking of two really key points. So firstly, fair value is a market-based measurement. It's not an entity-specific perspective. So what that means in practice, we're incorporating market-related inputs and assumptions that market participants would make if they're pricing an asset or liability. So I mentioned an example of calculating fair value as part of impairment testing. There's going to be key differences between the entity-specific estimates that would support a calculation of value in use, and then the market assessment used to calculate fair value. And if we're talking today about climate, so thinking about when we're incorporating climate into any valuation, fair value implies that you would be looking at a market-based assessment of climate risks and opportunities, not solely the views of management. Now that clearly that can be quite challenging, because it means that we have to understand how climate assumptions are factored into market metrics like comparators that might be used, and clearly climate is going to impact companies in very many different ways. So that was the first sort of key point I wanted to think about. The second one, when we're talking about IFRS 13, is that the way the standard works is it has a clear hierarchy of the inputs that you would use when calculating a fair value. And the level of judgment that we would have between those different levels is very different. So if we have a level 1 input, these are where we have something that is traded in an active market. Transactions take place really frequently, and we've got enough transactions to be able to have a reliable price on an ongoing basis. So for this, IFRS 13 is quite clear. We use those level 1 inputs where available. And so there is no sort of discussion about incorporating any sort of climate related overlays or anything like that into that price. But that's going to be quite different in terms of when we're thinking about climate and the level of judgment and input that you might have with, for example, a level 3 input, which is where we're looking at significant unobservable inputs. in that case, we might be taking a number of different approaches to valuation, whether that is market-based, income-based, or cost-based. But in all of them, it's likely that there's going to be a lot more judgment and therefore disclosure as well required to explain how climate factors might have been incorporated into those unobservable inputs that we're talking about for a level 3 valuation. I thought it's helpful just to think about each of those methodologies and measurement methodologies in turn. So starting off, if we have a market-based approach, so this is where we're applying market multiples to earnings or potentially book values. Take an example of where this could be relevant. Let's say we're calculating the fair value of a CGU for the purposes of impairment testing. Now, climate factors could impact those earnings. We know that because they might impact both the revenues or the cost base, or perhaps both. In fact, it can actually be really challenging to think through which party might bear the costs, whether it's you or your suppliers or your customers, when we're thinking about future impacts from climate change. And so that can be a real challenge when calculating earnings. If we think of an example from a manufacturer, perhaps, if they're facing higher costs of production due to something like carbon taxes, energy costs, raw material supply issues driven by physical changes, how much of that cost are they going to absorb versus pass on to customers? This is going to be something that's quite challenging to think about when you're preparing those earnings forecasts. I think climate factors also are clearly going to impact the multiples used, and this does open up quite a few challenges in practice. How comparable are the comparable multiples used? Some climate impacts are going to impact industries in perhaps a more consistent way. So let's think the changes in oil prices on energy companies, for example. But if climate factors are very different depending on locations or different business strategies or management responses, perhaps, then it might make identifying appropriate multiples even more challenging than it is now. So that was our market-based methodology. Another way that you could be doing the valuation would be looking at using an income method. So as an example, this could be if you were calculating the fair value of an unquoted investment. A really common method here is that we're using a discounted cash flow calculation. So thinking about what are the key inputs on that, we're relying on forecasts of cash flows. We're looking at a discount rate and potentially also a terminal growth rate. Now, climate factors need to be incorporated into those inputs, but it's really important as well that we don't try and account for anything twice. So if we've got cash flows that are being adjusted for climate risk, then it may be that the discount rate is not adjusted for those particular risks. Or you could do it the other way around, but then the challenge is clearly understanding what that discount rate should be. I think terminal growth rates is a topic I'll come back to in a minute, because that is a really important consideration when we're thinking about fair values in a climate impacted world. The final method then, just to mention, is the cost method, and this is where we're looking at something like a replacement cost or a net asset value, and that's, I guess, most typically for very specialized items of PPE, something like that in a purchase price allocation exercise, perhaps. The challenge here is really understanding how something like, or an example of a challenge is thinking about how perhaps future obsolescence caused by some transition climate risks might be incorporated. That's likely to be increasingly a challenge as companies' climate commitments start to really impact what they do, and assets are replaced, or there starts to be a bit more technological substitution. So that's a little bit about each of those methods. I think from my perspective, incorporating climate assumptions into any of these methods is going to be challenging, but that doesn't mean that change the fact that it's important. For me, if climate assumptions are in some way material to the valuation, it's just incredibly important to disclose what assumptions are being used and how they are impacting that valuation. That way, users of the reporting can understand how the value is impacted and make their own assessments accordingly. I said I'd come back briefly to terminal values. I think this is a really important topic. In some extreme cases, there is that fundamental question, actually, is terminal value appropriate at all if an asset is going to become stranded as a result of climate factors? We could take an example of so a company involved in something like diesel-powered passenger vehicle technology. If we've got incoming legislation that says that technology is not going to be able to be used in future, then there's a real question about whether there should be an end date to those cash flows as well. But more broadly, there will be a lot of instances where terminal values are still appropriate, but it's really important to consider, what's the impact of climate on that terminal growth rate. So linking to macroeconomic modelling and understanding how the business is exposed to different risks is vital. And here, we can see that the assumptions used could have a really dramatic impact on valuation, where a lot of the value is from that terminal value or the longer term use of an asset. Another area, it's also important if you're applying a terminal value, a terminal growth rate, to make sure that that's being applied to a set of cash flows that is sort of in a steady state. There might be costs or changes in the final year to make sure that what's extrapolated is appropriate. So I've talked a lot already about that and about measurement. I think before I just cover my little example very briefly, we did talk quite a lot in the paper, which you'll be able to see, about disclosure, and this is really important. There are so many disclosure requirements, particularly in relation to these more judgmental level 3 valuations, and that's asking for both qualitative and quantitative information. I think, just thinking about some of the examples, you have to identify what those unobservable inputs are and describe things like the sensitivity of the fair value measurements to changes in those inputs and the interrelationship. So I think it's also, we're talking about IFRS 13 here, but we also need to think about IAS 1 and whether there's any disclosures about whether these are key judgments or estimates that might be relevant. There's lots of information that might form material information around climate in this space. It is judgmental and it can have a material impact. So it's just important to be talking about how you've approached it. So just talking about the example then. So we've got a very summarized case study on the slide here. It's based on one of the examples in the paper. So in the scenario here, we have a company which has 2 minority investments. One of them is a premium listed business, so it's an actively traded shares, and the second one then is an unquoted company. And so when we're looking at that unquoted company, we're thinking about a level 3 valuation, and that's where there's going to be more judgment. So when we were looking at the listed investment, we made a valuation based on the listed share price. And IFRS 13, as I said at the start, is clear that level 1 inputs should be used where possible. But the unlisted investment, then what we were thinking about was, how is our market participant going to expect that investment is exposed to climate risks and opportunities, and what's the impact on its forecast earnings? So in the example, we were looking at climate adjusted cash flows, which are then discounted at a market rate of return. We didn't adjust in the example. We talked about the fact that because the cash flows were adjusted, we didn't then adjust the discount rate as well. In this example, we can talk about a terminal growth rate might be appropriate, but then that was modeled taking into account some of the chronic risks that are expected to impact the business that we'd identified. And then in the example, we then talked about, there's a lot of disclosure requirements to think about what are the key inputs and assumptions, both IFRS 13, but also thinking about IAS 1. So lots to think about in relation to IFRS 13. Just to summarize though, I think that the main thing is to just ensure that where we do have material risks or opportunities about climate that impact that asset being valued, it's just important to make that clear, explain how those assumptions have been included and what changes to those assumptions might do to your valuation. So I'm going to stop there and hand over to Charlotte, who's going to talk a little bit about the financial instrument standards.
Thank you, Helena. Hello all. As Sandeep mentioned, my name is Charlotte Loh and I'm a director at KPMG Banking Accounting Advisory, which means by default, I have drawn the short straw for the next two topics of IFRS 9 financial instruments as well as IFRS 7 financial instruments disclosures. Like many IFRSs, IFRS 9 has a wide application impacting many types of financial assets like cash and receivables, or financial liabilities like debts, equities like shares, and of course, derivatives. Now for this session, I will discuss the climate-related implication on the classification of financial assets and financial liabilities and how climate risk could impact IFRS 9 expected credit losses. As we have limited time, I will only discuss one illustrative example for IFRS 9 classification of financial assets. Now, even though preparers may also need to consider the potential climate-related implications on hedge accounting, such as the increased uncertainty in future forecasts leading to hedge ineffectiveness, hedge accounting is not in the scope of this presentation or in the paper, in the CDSB paper, so fear not. There is no hedge accounting today. I will end my session by discussing some of the disclosure considerations of climate risks in relation to financial instruments. And again, I will also discuss one illustrative example. Now, there is probably a presumption that IFRS 9 impacts financial institutions more than corporates, because financial instruments are generally what you see on the balance sheet of the financial institutions. So for this reason, the illustrative examples that I will be discussing are in respect of banks, partly because there have been a surge in green or sustainable loans and products in recent years. And just to paraphrase Prince Charles on what he says about being in love is whatever green means. Now, these new products linking to climate risk do, to some extent, allow banks to show how they are playing a part in the transition towards a lower carbon economy. But it is also a growth opportunity for banks as well. However, it is important for not just the banks, but also the corporate customers to consider the accounting implication for financial instruments that actually have contractual terms that have climate features. Now, for financial asset, I think one of the most important steps after concluding that a financial asset should be recognized is actually to determine its classification. If the financial asset is a loan, the lender, if it is a bank, generally prefers to carry them at the classification of amortized cost rather than fair value through P&L to avoid P&L volatility. Now, the classification under IFRS 9 is dependent on whether the loan or the financial asset is within a portfolio where the business model is to hold and collect, and also whether the cash flows from the financial asset represent solely payments of principal and interest, or what we affectionately call it SPPI. So what happens if the loan has climate-related features? Well, we have a simple example on the slide, as you can see. I'll call it simple with inverted commas, where a bank offers, again, a green loan to a customer where the interest rate is dependent on the customer's greenhouse gas or GHG emissions, reducing to a level of its baseline in a particular year in the future. So in other words, if the customer's GHG emissions does not decrease fast enough, or God forbid, goes the other way, then the interest rate charged by the bank will increase. And if it meets its target, then the interest rate will decrease. Now, although IFRS 9 does not explicitly address climate features, the ISB staff guidance that was published in July this year explained that ESG, or in this case, a climate risk feature, can only be considered to be reflective of credit risk if the adjustment to the interest rate is specific to the borrower and indicative of the changes in the credit risk associated with the principal amount outstanding. Now you're thinking, my goodness, that's quite a lot to take in. Well, in general, most ESG targets are broader in nature. So whilst the target specified in this example relates to the borrower, it may not have direct impacts on the credit risk of that borrower or indeed that loan. So I'm going to repeat that again. Even though ESG targets are broader in nature and the target specified in this example does relate to the borrower, it may not have a direct effect on the credit risk of that borrower or the loan. Therefore, in this example, it is actually difficult to correlate the borrower's performance against the baseline GHG emissions to the credit risk on the principal of the loan. That means that a more detailed analysis would be required, and unless it is proven otherwise, it is likely that this ESG or climate risk feature on the interest rate is actually not linked to the credit risk of the customer. Now, before I sort of say what the final conclusion would be on this very simple example, I just want to talk a little bit about what we call the de minimis effect. Now, a basic lending arrangement may include a contractual feature that has a de minimis effect in all possible scenarios. Now, if the variation of the interest in this particular case as a result of the non-performance by the borrower of its climate-related target does not have a material effect on the cash flows of the financial asset, then it may be possible to argue that such features are de minimis and therefore consistent with the basic lending feature to sort of try to conclude that this will meet SPPI. I should mention that de minimis is not the same as not material or insignificant, and it does need to be assessed on a financial instrument level. In this example, and when you read the paper later on, the climate risk feature appears to be more than a de minimis effect on the contractual cash flows, and therefore the loan would probably or most likely fail the SPPI criterion and should actually be classified as fair value through P&L. Now, it seems somewhat counterintuitive that on one side, banks are trying to provide products that are green in nature, but the accounting might be a bit of a hurdle for them. But the sort of message is that I think a detailed analysis would always be required with regards to anything with a climate risk feature. Now, if a financial asset does meet the SPPI criterion, then it will be accounted for at amortized cost. And if we look to the sort of left box in the slide, it means that the follow-up analysis is to determine IFRS 9 expected credit losses, or ECL. Now, I think most of us know, since IFRS 9 has been around for quite a while, that under IFRS 9, it is not necessary for a loss event to occur before an impairment loss is recognized. Therefore, just like any other risk that could impact the ability of the issuer or the borrower to repay the loan, climate risk can impact the initial and subsequent accounting for financial assets. Now, the assessment of ECL is based on reasonable and supportable information. That means information that are reasonably available without undue cost or effort at the reporting date. The impact of climate risk factors on ECL will vary depending on the severity and timing of the expected credit risk, climate risks, their direct and indirect impact on the borrower and the lender's portfolio, and of course, the duration of the loan portfolio. Now, the impact on expected credit loss today is potentially limited, largely because the most significant effects of climate change are expected to emerge over the medium to longer term. So while all of us potentially could give a minor sigh of relief that, oh, maybe I don't have to provide for anything this year, that statement alone, personally, I feel is not comforting at all. If you think about the most significant effect of climate change are expecting to emerge. And some might even argue, really, if we look around the weather, the severity of the weather around us. So again, the key message is, it is important to monitor the speed and scale of these matters and consider their possible impacts on the measurement of ECL. And many financial institutions are actually assessing this and considering including this into their calculation. Last but not least, I just want to talk a little bit about financial liabilities. I don't want it to feel like it's been left out, and how climate related features could impact their accounting. Before I go into that, I think we need to remind ourselves that the classification of financial liabilities under IFRS 9 does not follow the same model as financial assets. So when we look at the various types of financial liabilities, we actually note that climate-related features are actually commonly seen in borrowings as opposed to trade and other payables. Therefore, if the borrowings, bonds, or notes issued contain climate-related features, they should be assessed carefully. And the reason I say that is to determine if these features meet the definition of an embedded derivative as defined under IFRS 9. Now, if so, then that embedded derivative within that financial liability may need to be separated such that the host financial liability is accounted at amortized cost, while the separated embedded derivative is at fair value through P&L. So in summary, it is important to assess the climate-related features in both financial assets and financial liabilities to ensure the appropriate classification and the initial measurement. And depending on the result of the initial measurement, the follow-up analysis require additional data and understanding of how climate risk impact the exposure from an impairment perspective for financial assets at amortized cost, or day two fair value for financial assets and financial liabilities that you are required to fair value through P&L. Now, if we can go on to the next slide. Now, you know IFRS 9 is bad news, yeah, when it has its own accounting standard for presentation as well as disclosure requirements. But before I discuss further, just remind ourselves that IFRS 7 is about the additional disclosure requirements of financial instruments, and in particular, their risk profiles and exposures. Now, with the emergence of climate risk, it is likely that IFRS 7 disclosures should not be limited to credit, liquidity, and market risk, what we call the usual suspects. Many organizations have actually and have now included in their risk management frameworks climate risks. However, I think preparers may need to determine that climate risk does not, may determine that the climate risk may not impact the current period financial position or performance. So they've included in their risk frameworks, but they may conclude that it doesn't affect their current financial period position or performance. Nevertheless, they should continue to assess this and actually identify disclosures under IFRS 7 that is material, and if so, should be provided. So again, let's look at a simple example on this slide that may be relevant. So let's say Bank E provides corporate loans to customers operating across the US. Now, if we consider the application of IFRS 7, then Bank E should consider disclosing how it is managing the risk arising from climate change on the borrower's business, and also if there is collateral obtained And in particular, if that collateral is a property, then Bank E probably need to consider where is that property located, whether it is in what we call a high storm damage risk zone. Now, Bank E will probably need to consider quantitative disclosure on how it determines concentration of credit risk, for example, on the borrower, the geography area, and so forth. Now, I mentioned earlier that perhaps many have not really incorporated climate risk in determining ECL because it is quite hard to forecast the impact of climate risk. But if Bank E does include climate risk in its determination of ECL, then it should provide not only the quantitative disclosure as required, but also qualitative disclosures. So for example, Bank E could disclose how it adjusts the collateral value, if there is any, in determining the loss given default, or LGD, such as including a larger negative adjustment to the market value of properties exposed to high climate risk zones. It could also include disclosure of how it adjusts the probability of default to reflect the increased physical risks for the borrower. Bank E should also consider disclosing assumptions and where material management overlay, which is commonly seen in IFRS 9 ECL, particularly in relation to exposures to carbon-intensive industries. So you can see from this simple example, there are likely to be additional disclosure, which means I'm calling out the elephant in the room again, which I did earlier. It means that you need additional data, which potentially Bank E or any financial institution may not have it readily on hand. So on that bombshell, I'm going to hand you back to Helena.
Thank you, Charlotte. No, that was really, really interesting to go through. Just to carry on the story, then I guess a couple of the other, I'm going to just talk now about a couple of the other standards that we included in the paper. So the first one of those is talking about IAS 12 and looking at income taxes. So when we looked at this and the potential impacts of climate on accounting for income tax, I think it's fair to say there was one topic that really stood out above everything else in terms of complexity and scale of impact, and particularly, I guess, the potential for impact now. And that topic was the recoverability of deferred tax assets. So I'm going to focus on that for most of this section, but before I do go on to that, I did want to talk very briefly about a couple of other relevant topics when we're talking about tax accounting. So the first of all, one of those questions is it actually an IAS 12 tax at all? And then secondly is how might some new taxes or changes in strategy that you might be making at the moment, if you're making decarbonisation commitments, for example, how might that impact your current and your deferred tax balances? I'm not going to be talking about any specific taxes or jurisdictional based impacts here, but I'm just going to try and stick to, I guess, the accounting principles. So first question, as I said, before we go into the main bit about deferred tax assets, is it an IAS 12 tax? For me, the key point here is to understand, is it a tax based on income or is it based on something else? And that could be like revenues or units of production. If it's not an income tax, then it's not in the scope of IAS 12. And that matters because it might be accounted for under a different standard, and you might recognize the impact therefore at a different time or on a different line. And thinking about how this relates to climate, then this could be relevant for some of the different types of carbon taxes that we're seeing. The second point that then I just wanted to address very quickly was thinking about, well, how might climate impact different stages of a deferred tax calculation? So going back to real basics, if we're calculating deferred tax, what we are doing is we are going through to calculate the tax base of the asset or liability. We're comparing that to the carrying value, and then we're thinking about whether that difference between the tax base and the carrying value ends up resulting in some kind of deferred tax asset or liability. So thinking about each of those, then if we're thinking about the tax base, then there are going to be different ways that climate can impact that. So it could be a new tax being introduced that changes how an asset or liability is treated, or it could be a change in your own strategy that means that your intention for how you'll use that asset changes, and then for potentially so does the tax treatment. I think as more companies are implementing changing strategies to deal with their exposure to climate risk and opportunities, the tax accounting needs to keep up to that. So that's talking about the tax base. We also need to think about the fact that the carrying value may well change too. As we go into the future, I think a lot of people expect there will be an increase in climate related impairments, for example, or changes in depreciation profiles, new provisions, things like that. So it's really important to track through where you have got those changes to make sure that you've also thought about the impact for tax. The really key issue, though, when we're talking about IAS 12, though, I want to talk about is recoverability of deferred tax assets. The fact that deferred tax assets are very commonly quite long-term, and their recognition relies on the existence of taxable profits, what could be quite a long way, and in certain cases, quite a long way into the future, means that this is an area where climate factors really can impact the balance sheet now. And even if you determine that there isn't an adjustment, there isn't an impact on the balance sheet today, it certainly might be that there are material assumptions or judgments to disclose around how you came to that conclusion. So sticking to the theory for a minute, when do we get deferred tax assets? Well, we get them when we have deductible temporary differences or unused tax losses or credits. And we say that it's probable that we will have future taxable profits when those differences reverse or when we use those losses. So hopefully you're all aware, climate factors can have a significant impact on future profits. And very, very commonly, they may introduce additional uncertainty about what those profits might be. And when we're thinking about the implication on deferred tax, it means it might be more challenging to justify the recognition or retention of deferred tax assets on the balance sheet. As I said, we can only recognise that deferred tax asset if it's probable that there are going to be futurable taxable profits at the right time. Taking an example then, let's say we have an airline who have very significant deferred tax assets. Now, as an airline, they are going to be exposed to a range of different transition climate risks, particularly, whether it's the impact of future, for example, air passenger duties or carbon taxes, or just changes in market demand for flights, fuel prices, all sorts of different impacts that are going to change both their cost base and also their future revenue. Now, if that airline is going to support the recognition of their deferred tax assets into the future, then they've got to think about, I guess, first, are there any deferred tax liabilities that are going to reverse, which would enable us to recognise some of that deferred tax asset? And then if there's insufficient deferred tax liabilities reversing, then we need to think about this projection of future taxable profits. If we're making those projections, they've got to be based on the same basic forecasts and assumptions that we're using for other calculations like impairment testing, but there's going to be tax specific treatments included in there too. And what we're looking for is that it's only if it's deemed probable that sufficient profits will be available that we can actually recognise that deferred tax asset. Finally, on IAS 12 then, I think what I wanted to end with was just it's really important to disclose the nature of evidence supporting the recognition. If this is a key judgment or there are key estimates involved, then it might be material as well to provide some disclosure under IAS 1. So that's all I wanted to say on IAS 12 for today. The last standard that I wanted to cover just for today's session was talking about IAS 2 and inventories. Now, some of you might be thinking, wait a minute, inventories are our current assets. Are they really going to be significantly exposed to climate risk? Is there a significant risk of a change because of climate to the inventory that I recognise on my balance sheet today? I think it's definitely fair to say that for some and even many industries, you might be right. If inventories turn very quickly, then the potential for significant climate-related changes to what we have on the balance sheet today is going to be lower, because many climate factors will be impacting over the more medium to long term. Now, this isn't like the deferred tax assets that I was just talking about, where we could be reliant on profits many, many years into the future. But what we wanted to cover in the paper, and just to highlight very briefly today, is that it doesn't mean, though, that inventories can't be impacted. No, there are industries that do hold inventory for a much longer period of time, and that gives there to be more scope for climate factors to impact the accounting. In the paper and on the screen today, you can see we used the example of a house builder who had a very significant material land bank. Now, we chose that because it was an example of a long-term asset that is exposed to physical climate risk. We could have talked about something like a manufacturer who's holding inventory over a longer term to perhaps service older models that they've produced. When we're thinking about value of inventory, then we're looking at, is the cost higher or lower than the net realizable value? And cost, that's when we're talking about cost of purchase, conversion, and bringing it to their present location. And when we're thinking about costs, it excludes stuff like abnormal costs from stoppages or interruptions. And we need to think about the impact of whether there might be climate-related stoppages or interruptions that we would need to exclude. We then compare that cost to the net realizable value, or the estimated selling price in the ordinary course of business, less things like cost to complete and cost to make the sale. So that's what we were looking at in the example. If you are in the case of being in an industry where you do have very significant inventory balances or hold them for a long time, then what we were thinking about in our example was, what are the implications of climate on that net realizable value from the climate factors? In the land bank example, then we talked in the paper, and if you have a chance to read it, you'll see we talked about the fact that management needed to consider what was the impact of particular physical risks that they'd identified on the estimated selling price and the market conditions, and also the impact of legislation that might determine the value of that land and their ability to sell it. In that example, spoilers, we decided that the impact of flood risk, the net realizable value was actually nil, and therefore they had to have a material impairment. But the point of the example was just to illustrate that it is really important to think about how those climate factors might impact the valuation of that net realizable value, and then to be disclosing as well where you have had a big impact. So just to sum up on inventory, it is a huge item on the balance sheet of many, many companies. And it is likely that there might be impacts to what you include in cost of inventory over time. But I think when we were doing the analysis, for us, the type of impacts that's most likely to be relevant on your accounting judgments today, maybe where you do have some of those longer term inventory balances that are particularly exposed to climate risk. So that's all I wanted to say on inventory for today. I hope that was a useful rattle through some of the key standards. I think if I pass back to Sundip now to just have a few words to conclude.
Fantastic. Thank you so much, Helen and Charlotte. There's a lot of content covered in the paper that you guys have both contributed heavily to, and trying to kind of cover that all off in under an hour is no easy feat, but hopefully our audience has found that useful. And as we said a few times, the details in the paper, there's some really fantastic illustrative examples to bring to life some of the theoretical elements that we've covered. So please do take a look at that. And I have added a link in the chat to the paper, so you can go and look for that right after this session. We've got a few minutes left for some questions that have come through, so we'll try and take this quickly, but I'm always keen to give time back so we don't have to end on the hour if you don't need to. So the first one that's come through, to what extent is accounting for climate in financial reporting already required, or what is the expectation for the near future? Helen and Charlotte,
shall I take that one?
Yeah.
So I think what I would reflect on this question is what we've been talking about today are current IFRS standards. we're not talking about something new coming in. This is just what IFRS says now. And it's just really making sure that as everybody's awareness and also the scale of impacts from climate is growing, that we're really reflecting that in those financial statements. So it's not a case of new requirements coming in. It's just making sure we're really including all of the material impacts that we need to think about in our financial reporting now. And I think just to answer that question as well, I think there was a really important word that I included in that answer, which was material. And so when we're preparing financial statements, we are including information that is material to the users of that might influence the decisions that they make. That's the sort of IFRS, part of the IFRS definition of materiality. And so it is possible that climate-related matters might materially impact your financial statements. And therefore, you need to talk about, if that is the case, how that has impacted you. And then it's also thinking about the disclosure around, are there climate-related matters, perhaps, that because of the industry where you operate, that users of your financial statements might expect to impact you. And if that's the case, it's important to make clear how that might in fact impact you. So materiality is, I could talk for hours on this, which I'm not going to, I promise, but it's such an important topic. And so basically, yes, this is current legislation, and I think the expectation is that people just talk about it more and really do a greater level of analysis than perhaps has gone on in the past.
Brilliant. And one thing I guess I'd add as well is yes, it is very much needed if you are following IFRS, but equally, one of the stakeholders I didn't mention is that the regulators are taking a closer look at this. Last year, the FRC in their climate thematic started looking into the financial reporting elements alongside other climate reporting aspects. So it is very much on their radar, and it's something they'll be focusing on more closely as well.
Maybe just to add very quickly, there was two benchmark report that KPMG produced on 25 banks globally. And we did notice that when it comes to climate in financial reporting, they actually sort of look to certain recommendations, example by TCFD, to actually report on climate. And I guess it's important to distinguish between the accounting for climate in whatever you have, as well as the reporting of that. I think that's important. I think the accounting is already here when it's, as Helena quite rightly say, material.
Wonderful. Very briefly, so we had a couple of questions myself. We'll quickly touch on it. Are there any good examples of companies already reflecting climate impacts in their financial reporting? Have you guys seen anything?
I'm always nervous, I guess, about advocating particular companies. It's always difficult. I think if you're interested in this topic, I think there was a really interesting report that came out from Climate Tracker, actually, which came out a few weeks ago now, sort of doing a bit of a review on the state of climate in financial statements, and that it brought out some less good examples, I would say, as well as some examples that they thought were a bit better. So if you're looking for analysis on what companies do, particularly in particularly climate and impacted sectors, that's quite an interesting report to have a look at.
Brilliant. And I think the very reason why we're doing these papers still and providing illustrative examples is because there aren't enough solid good examples out there. So hopefully this will drive good practice in coming years. We are very close to the hour, so I'm going to end there on the questions. Just a couple of things to add before we close up. We do have a second supplementary paper that will be launching towards the end of next month, towards late November, early December, which will be looking at additional accounting standards, not necessarily picked up by the IFRS Foundation or IASB previously, but as the paper, the standards themselves said, the list they had initially was not exhaustive. So there are other standards where climate may potentially be impacted. So do look out for that, and we'll have a corresponding webinar which you can register online per the link on the screen. With that, just want to say thank you again to Helena and Charlotte and equally the KPMG team who have been behind a lot of content that's found in the paper. Thank you so much today and for all of the hard work behind that. And thank you to our audience who've joined today. Please do look out for the coming session at the end of next month. Thank you and goodbye.
Thanks everyone. Bye.
Thank you.